So just a couple of ground rules to get started. I hope everyone has received the webinar handouts by email because basically this is going to be the material that we cover this morning and it makes a handy place to take notes. I want to ask everyone to please feel free to ask questions during the class. We don't have a moderator today, so if you want to ask a question, just pipe up and ask your question out loud, and I'll stop and hopefully be able to answer your question. Also, at the end of your handouts, you'll find some additional resources, including how to request one-on-one business coaching from one of us at no cost to you. And finally, again, my name's Warren Mueller. I'm one of the business coaches here at the SBDC. I'm in my 5th year following a 30-year business career of various sorts, and I am also a small business owner. So let's go ahead and jump in. So why do we have to concern ourselves with financial statements? Well, one key reason is all the information we keep about our business for tax filing purposes has little to no managerial value. And one key reason for that is we only file taxes typically once per year. And looking at your business numbers once per year is not going to be an effective way to financially manage your business. Also, if you've ever filed taxes as a small business, you'll probably notice that costs are captured on tax forms in a way that really provide no insight as to how the business is running. And so we need to do something different than just collecting numbers for filing tax purposes. So another thing is financial statements help us to manage scarce resources like time and money. If we had time to introduce ourselves this morning, we'd all find that we come from different backgrounds, different experiences, and that we're doing different things. But most likely, we have two resources, scarce resources in common. And one of those is time. We never have enough time to do all the things that we want or need to do. And the other one's money. I've never met anyone who's had all the money they need to do all the things they want or needed to do. So financial statements help us to manage those scarce resources and leverage them for maximum impact on our business. They also give us tools to help understand how well our business is performing and also point to ways that we can improve business performance. And here's another reason that people don't often think of, and that is as your business gets larger, your financial statements become more important in terms of managing that business. I mean, think of it this way. You may have started your business literally on your dining room table. And when you were at that level of activity, it was pretty easy to keep track of what you were producing, what you had to sell, what you had to ship, and what raw materials you may have had on hand, and how much money was coming in and how much money was going out. But as you scale up to a larger facility with more complexity, and if you expand to more than one location or maybe more than one fulfillment channel, it becomes harder and harder to keep track of what's going on in all the activities taking place. And so financial statements become the tool that actually lets you do that. So what we're going to talk about this morning is, first of all, the profit and loss statement and the various components that make up that statement. Secondly, we'll talk about a concept known as gross margin that, among other things, we can use to make important management decisions in our business. Then we'll move over and talk about how we go about developing budgets for our business. And then we'll end up by talking about how we can use our profit and loss statement and the budgets we've developed for financial management. So what is the profit and loss statement? Well, fundamentally, it's a financial statement that compares our revenues to our expenses in a way that illustrates our business performance. And depending on the nature of your business, we use these profit and loss statements either on a monthly basis, a weekly basis, or a daily basis in order to assess business performance. Now, having said that, the majority of small businesses tend to use their profit and loss statements on a monthly basis. We close out the books for a month, we prepare the profit and loss statement, and then we examine that statement to figure out how our business performed in that particular month. Now, nowadays, the raw data that we collect on revenues and expenses is typically gathered into a software program like QuickBooks, which is very handy because QuickBooks will automatically generate the profit and loss statement when you ask it to. Now, it's still feasible to collect that data on paper, typically in ledger books. It's also possible to collect that data in Excel spreadsheets, and depending on your business scale, those are both perfectly fine ways to do that. But more and more businesses, even small businesses, are turning to QuickBooks and other software programs to both automate the collection of that data as well as automate the generation of the profit and loss statement. So here's a typical profit and loss statement. This is a fictitious company, and this particular statement comes from April of 2019. And to the right of the statement, we've labeled the key components of the profit and loss statement. And we're going to talk about these components in a pretty good amount of detail. But basically right now, taking the 50,000 foot view here, here's a couple of things that we can observe about this statement. First of all, the top half of the statement, which is this part, basically tells us how much revenue we've generated in a particular period of time, in this case, April of 2019, and it tells us something about how efficiently we've generated that revenue. The bottom half of the statement, this part here, basically tells us how much infrastructure we've used in order to support the whole business enterprise. And then finally, the statement ends up with net income, which tells us something about money that is available to us to spend after all the expenses we've incurred have been subtracted from our revenues. So let's go in with the first component now, and that's revenue. As you can see, revenue appears at the very top of the profit and loss statement. It always does. And basically, revenue represents monetary value that's booked into a business revenue account. And a revenue account is nothing more than just the place where we gather the information on revenues. Again, it can be a piece of paper, it could be an Excel spreadsheet, and it can be QuickBooks or similar programs. Now you'll see profit and loss statements where this section is either labeled as income or as sales instead of revenue. And those titles are perfectly fine. They mean the same thing, and they appear at the very top of the revenue statement, profit and loss statement. Revenue comes into a business when that business sells something, whether it's a tangible product or whether it's a service. And legally, a sale is consummated or completed when ownership of something passes from the seller to the buyer in consideration of some price, And when that happens, that's the point at which we book the monetary value of that transaction to our revenue account. And so whether it's a tangible product or whether it's a service, ownership of those things passes from the seller to the buyer in consideration of a price, which we then book to our revenue account. Now, I talk about booking the monetary value of the transaction to the revenue account and not booking cash because in the act of sale, which we said is a passage of ownership from seller to buyer in consideration of a price, such that we book some monetary value to a business account, when we do that, it does not mean we have actually received any real cash into the business. And that might sound strange when you first hear it, but think about the case of someone visiting a furniture store. If you've ever bought a piece of furniture from a real furniture store, the transaction might go something like this. You go to the store, let's say you find a couch that you really like, and that couch has a price of $1,500 on it. And you're standing there pondering whether you want to spend that money today or not. And then a salesperson comes up to you and says, hey, we can make it very easy for you. You can take the couch home today, and you don't have to pay us any cash for 30 days. That's called cash. That's called net cash in 30 days. Excuse me. And what it means is the business is willing to allow the ownership of the couch to transfer from them to you, the customer, so that you can take it home today, and you don't have to pay them any cash for 30 days. And so when they transfer that ownership to you, they book the sale that day, even though they don't receive cash for 30 days. We won't talk about that anymore today, but it is an important consideration in business financial management if you do give terms like that to your customers. Any question on revenue? All righty, let's go to the next part of the profit and loss statement, which is cost of goods sold. As you'll see, cost of goods sold as a category appears below the revenue category. And cost of goods sold is just simply the cost that we incur so that we can sell something to someone. And so a cost that we can identify as being directly related to selling something is called a direct cost, and it's placed in the cost of goods part of the profit and loss statement. So let's pretend, just for a moment to illustrate how this works, let's pretend that we have a business, an online business, and we sell a toy, okay? So what might be the direct costs involved in selling that toy? Well, we probably need raw material to buy raw materials in order to make the toy. There's probably some labor we have to pay for in order to assemble the toy. And then there might be labor and material involved in packaging the toy. And then finally, since we're an online business, we'll probably be shipping that toy to a customer, and there'll be a cost involved in that. And so since in theory, we can measure how much of each of these costs are incurred in selling a toy, we call those direct costs, and we place them in the cost of goods category of the profit and loss statement. Now, we can certainly have expenses in our business that do not belong in cost of goods sold, and one can be marketing. We typically cannot determine how much marketing costs attaches to a given toy sale. And so marketing costs don't go in cost of goods sold typically. You know, an example of this might be for our toy business. Let's pretend that we we lease a billboard on I-90. Okay, that's a marketing expense. Well, if somebody up in Athol finds our website and decides to buy the toy, that billboard has had no effect probably on that person in Athol. And so there's no marketing cost attached to that particular sale. On the other hand, we might have somebody who drives up and down I-90 every day to go to work, and they see the billboard and they see the toy and they see our website and they realize, hey, my kid has a birthday tomorrow, I'm going to buy that toy. Well, the billboard has had a big impact on that particular sale, but we never know how that works. And so that's why typically marketing costs don't go into cost of goods sold. Now, another way to determine whether a cost goes into cost of goods sold is something that we call the shutdown test for cost of goods sold. And basically it goes like this. Let's pretend that we're going to stop selling product for 4 weeks. We're not going to sell any product for 4 weeks. If that were the case, what costs within our business would go away? Well, if we're not selling any toys, we're probably not making any toys, so we don't need to buy any raw materials. And if we're not making any toys, we don't need to pay anybody to make the toys. And if we're not going to ship any toys, we don't need to pay any labor or packaging expenses to package the toy. And certainly we're not going to be shipping any toys, so that cost goes away also. So in the shutdown test, if a cost goes away because you're shut down, that's probably a direct cost of selling, and it goes in cost of goods sold. If we really did shut down for 4 weeks and we had a 6-month lease on that billboard on I-90, we'd still have to pay that lease cost every month. And so for that reason, the billboard does not belong in cost of goods sold. Any questions on that category?
Nope.
All righty, let's move on. So depending on what kind of a business you're in, there are some pretty typical costs that appear in cost of goods sold. If you make a tangible product that you sell, these costs almost always end up in cost of goods sold. Materials, labor, quality control, packaging, shipping costs, sales commissions, credit card transaction fees. If you're letting people pay by credit card, that fee is attached to that sale, and so rightly goes in cost of goods sold. If you're in a service business, like maybe a law firm, an accounting business, a plumbing business, these are the costs that typically show up in cost of goods sold. Direct labor for the plumber to go fix a problem, supplies that might be consumed by the plumber to fix the problem, parts that might be replaced, say in your toilet, in order to fix a problem there. And maybe even travel expense. If the plumber always goes from the home base to the customer and back, that travel expense can be captured as a part of cost of goods sold. And likewise, if the plumber gets a commission or a bonus on a job, that can be a part of cost of goods sold. And of course, again, the credit card transaction fees. Now, if you're in a food service business, and obviously that can be a restaurant, it can be a bakery, it could be food trucks, it can be pop-up stores, that type of thing. Your cost of goods sold are dominated by food costs and drink and labor. And so in the food service industry, food and drink costs typically run about 34% of sales. And labor typically runs on the order of about 32% of sales. And that's a pretty reliable indicator for most food service companies. Any questions on those? Okay. So now this takes us to the gross profit line in the profit and loss statement. And so the gross profit line falls right below cost of goods sold. And basically gross profit is revenues minus cost of goods sold equals gross profit. And basically gross profit is telling us how profitable our sales are, because it's the money that's left over after we pay for all the direct costs associated with generating revenue for our business by either selling products or services. And so it's telling us really how efficiently we're generating profit from the revenue that we've generated for a particular period of time. Now, for businesses that sell more than one product or sell more than one service, if we can measure the gross profit for each product or service that we sell, those gross profit numbers can tell us which of the sales are most valuable to us. That is, which sales net us the most money in gross profit. And so let's think about our toy business again. You know, instead of selling one toy, maybe we sell two toys. So we have toy one and we have toy number two. And maybe the price of each toy is the same, $100. Both toys sell for $100. But for toy number one, maybe the cost of goods sold is $70. And for toy number two, the cost of goods sold is $30. Well, in that case, the gross profit of toy number one is $30, and the gross profit of toy number two is $70. And so when we're thinking about selling an individual toy, it's obvious that toy number two is the more valuable sale to us. Now, it may happen that we sell 100 times more of toy number one than toy number two. So in terms of eventual income, toy one is more valuable, but on a sale by sale basis, toy number two nets us the most gross profit. Okay. Now there's an accounting term related to gross profit, and that term is gross margin. And gross margin is simply dividing gross profit by total revenue. And the result is expressed as a percentage. And so if we look at our profit and loss statement up here in the upper right-hand corner, we have a gross profit of $38,472. And if we divide that by the total revenue of that period, which is $84,803, that divides out to 0.45. And so we would call that a 45% gross margin. So when you hear people talking about, oh, I have a 50% margin business, they're probably talking about that their gross profit divided by the revenues is equal to 0.5, which is called a 50% gross margin. So let's look at a couple of examples of this. So if in our business, if we generate $100,000 of revenue in a particular period, say a particular month, and if our cost of goods sold is $45,000, then our gross profit is 100,000 minus 45,000 equals $55,000. This means that we've netted $55,000 for our business by selling $100,000 worth of products or services. Given these numbers, our gross margin, which is gross profit divided by revenue, is equal to 0.55 which we call a 55% gross margin. Now, you might be wondering, well, what's the importance of this gross margin number? Well, fundamentally, the gross margin number tells us something about the value that our business delivers to our customers. And so let's look at the example of a grocery store. Grocery stores tend to generate a gross margin of about 16 to 18%. That is, for any given period of time, when they divide their gross profits by their gross margins, they're generating about a 16 to 18% gross margin. That's pretty low. And so we might want to ask ourselves, why is it that the grocery store business generates such low gross margins? And the issue here is grocery stores don't add much value to the products that they sell. I mean, think about it. When they take a head of lettuce off a delivery truck and they put it on a shelf or in a bin for you to buy, they haven't added any value to that head of lettuce. It's the same head of lettuce that they took off the truck. Same thing with canned goods. They take canned goods off a truck, they stick it on a shelf so we can buy it, but they don't add any value to those canned goods. And so since there's no value added, and theoretically anybody could be in the grocery business because there's not much magic to it, there's a lot of competition in that business. We as customers have a lot of choices. We tend to buy on price. And so the result is the grocery store business generates relatively low gross margins because it doesn't add any value to its products. Now, an opposite example might be somebody who's in the business of baking custom bread. Let's say we're in this business, we make the greatest, the best sourdough bread that anyone has ever made anywhere. The taste, the smell, everything is just absolutely superlative. And because our loaf of bread is so generous and because it's so good, people are willing to pay us $7 for a loaf of bread. Okay? If you've been to any farmers markets and you've seen people selling custom bread, that's about the right price. But to make that loaf of bread, they may only use $1 of ingredients. And they may only input $1 worth of labor to make that loaf of bread. And so the gross profit on that loaf of bread is $5. And if we calculate the gross margin of that loaf of bread, it's $5 gross profit divided by a revenue of $7 is a gross margin of about 71%. Okay? What that tells us is the baker is taking $1 of ordinary ingredients and turning those ingredients into a product we're willing to pay $7 for. And so the baker is adding $6 to the value of those ingredients by his knowledge, his experience, his labor, etc. And so we call that bread a high value product. Any questions on gross margin and its way of showing value?
I'm with you.
Okay. Then let's look at how we can actually use gross margin to make some business decisions. So here's a common problem for small business owners. Your business is growing. You need to hire a new employee. You need to create a new position. And in this case, we want to hire a new assembly employee at $40,000 per year. Well, One of the things we should ask ourselves when we're thinking about creating a new position in our business is, how much new business do I have to generate in order to pay for that employee? Because if I don't generate enough business, then I'm going to end up paying for that employee out of my pocket. Well, it turns out that it's pretty simple to answer that question. The amount of new business that you need to generate in terms of dollars is just simply equal to the amount of the new expense divided by your gross margin. And so let's assume that whatever this business is, that it generates a gross margin of 38%. Okay. Well, the amount of new business that we need to generate to pay for that employee is the new expense of $40,000 per year divided by our gross margin of 0.38, which gives us about $105,000. And so what that says is, given this information, we would need to generate $105,000 in new business with this new employee in order to pay for that person. And so from a management decision standpoint, the question we have to ask ourselves is, if I hire that new employee, will that person allow me to generate $105,000 in new business? And if you're confident that the answer is yes, then yeah, you ought to absolutely hire that person. On the other hand, if you're not confident that that's the case, no, I don't think I could generate 105,000, then you might need to find some other ways to fill your employment need, maybe with part-time people, maybe paying overtime to your current employees, something like that. So a pretty quick and dirty way to analyze that situation. A similar situation is when you buy equipment for your business. Let's pretend we have some business that's making something and we have a packaging machine that packages our product, but the machine can't keep up with our production anymore. And so we need to buy a bigger machine for our production line. And we've done some research that tells us that the loan cost and maintenance cost for such a machine would run us about $1,450 per month. And so a management question is, how much new business do I need to generate in order to pay for that machine? And so it's the same thing as last time. The amount of new business is equal to the new expense divided by gross margin. And let's assume in this particular business that our gross margin is 52%. Well, then the calculation becomes our $1,450 per month divided by 0.52 equals about $2,789 per month. So we have to ask ourselves, if I get this new machine, will I be able to generate $2,789 per month? And if the answer is yes, then I ought to get the machine. And if the answer is no, then I'm going to have to figure out some other way to solve my problem. Any questions on that analysis method?
Nope, I'm with you.
Okay. All right. Then that takes us to the overhead expense part of the profit and loss statement. And as we can see, that category of expenses falls below the gross profit line. And as we said earlier at the beginning, overhead expenses really tells us something about the infrastructure that we use in order to support the whole business enterprise. Now, depending on who does your books and what system they use, overhead expenses can also be labeled as operating expenses, but they're the same thing and they appear in the same place in the profit and loss statement. The interesting thing about overhead expenses is they really tend to be fixed costs. You know, our lease for most of us stays the same every month. Insurance payments, Accounting charges all pretty much stay the same every month. And so what this means is whether we sell a lot of items in a month or we sell very few items in a month, our overhead expenses tend to stay pretty constant or fixed from month to month. And so again, overhead really represents the cost to us of maintaining the infrastructure we need to have in order to run our business. Now, because overhead expenses tend to be fixed, from a management input standpoint, we don't really have to spend much time every month worrying about our overhead expenses because they stay fixed. The lease is the same every month. So we don't have to really spend much time worrying about overhead expenses. And so for this reason, most of our management time in terms of financial management of the business will be focused on revenue and cost of goods sold, because these can change from month to month. And depending on the nature of our business, they might change dramatically. For example, if you're in the restaurant business, winters in North Idaho tend to be pretty tough on restaurant owners, whereas the summer months or the good months tend to be the months where you generally make your money for the year. Okay. Any overhead expense questions? All righty. So that brings us down to the last part of the profit and loss statement, which is net income. And as the name implies, it's the net value that remains for us after we've paid for all those expenses we talked about and have subtracted those from the revenues that we talked about. And for a lot of us, net income is also how we, the owner, gets paid. If you're a sole proprietorship or if you're an LLC, you don't tend to draw a salary. Actually, you don't draw a salary. You get paid out of net income. And so what happens is every month when your profit and loss statement is generated and you have a net income, the owner can take a draw, which appears below the net income line, and then that results in what we could call a net income. So it's net income of the business after the owner has taken a draw. Now, if you happen to be a subchapter S corporation, or if you file your taxes as a subchapter S, there is a provision there for the owner to take a salary. But that's a question that if you want to explore, you need to really talk to an accountant or a CPA. That's above our pay level here at the SBDC. So now that we've gone through this, let's go back and take a look at the whole profit and loss statement again. So this is what we looked at the very beginning of the training today. And now we can look at it with different eyes because we've talked about all of these components. And so, as we said earlier, the top half of the profit and loss statement tells us about how much revenue we've generated in a particular period of time and how efficiently we've generated it. This top part of the profit and loss statement is sometimes referred to as our revenue engine. Okay. And the reason why it's referred this way is this is the part of our business that generates the money. I mean, think about it when you're driving your car down the road. The whole car with you in it goes down the road, but it's only the engine that's developing the power that allows you and the car to go down the road. Everything else but the engine is just kind of along for the ride. Well, it's a similar principle here. Our whole business is described by the full profit and loss statement, but it's this part up here, the revenue engine, that generates the money that allows us to pay the infrastructure and then in the end pays us. And so this is why in terms of financial management, we'll spend more time looking at the revenue engine part of the business than we will the infrastructure part of the business. And again, the bottom half of the statement, which is this part down here, tells us how much infrastructure we've used in that period of time in order to support the whole business enterprise. And then finally, bottom, net income tells us about the money that's available to spend on ourselves as a draw, owner draw, or to spend on other things for the business. So this is going to bring us to the end of the profit and loss statement. Before we move on, are there any questions at all about this statement, the components, and what they mean?
Nope.
Okay. So now we're going to move on to budgets. Okay. So 2 questions. What is a budget and how do we go about preparing one? Well, a budget is really just a forecast of revenues and expenses for some future period in time. And for most small businesses, that future period of time is next year. And so most small businesses, and in fact, most businesses in general, prepare a January to December budget, and they do that activity during the last part of the current year, typically from October to December. And so we're here today at November the 4th, and businesses, and in particular small businesses all around the world, are working on their 2021 budgets. And so a key question is how do they go about doing that? And so it's a pretty simple process when you get down to it, because first of all, we're going to start with our current year experience. And so what that means is we're going to start with our year-to-date profit and loss statement. So we're sitting here in November. Ideally, you would have a profit and loss statement that describes your revenues and expenses all the way from January of this year through October. And so that's 10 months of data that we would start with in our budgeting process. Once we have that, then we want to think about any changes that are taking place in our business. Are we expanding our business? Are we taking on new products? Are we getting rid of old products? Did we acquire a business? All of those changes we want to forecast in terms of revenue for the next year. Likewise, do we know anything about changes in our lease, utility, insurance, marketing, payroll expenses? Do we know anything about it? If we do, we want to forecast that in next year's budget. And similarly, if we know anything about pending increases or decreases in our cost of goods sold, raw materials, labor, shipping, etc., whether they're going up or whether they're going down, we want to include those changes in our next year's forecast. Because basically what we're trying to do is we're trying to portray what we think the next year will look like. And now, I use the word portray for a specific reason, and that is preparing a budget is not trying to figure out exactly and precisely what's going to happen in the next 12 months. because that's basically impossible. What we're trying to do instead is apply our best intelligence to what might happen next year and create a 12-month story or picture of what we think next year will look like. So let's actually walk through the process. And so what we said was we need to start off with a current year profit and loss statement. And so let's all pretend for a moment that we're the owners of this fictitious business, the CDA Burger Company, and it's 2019. In fact, it's October of 2019. And so we have 9 months worth of data to work with. And so these are the actual revenues and expenses that our business has experienced in the first 9 months of 2019. And so given this, we now want to work on our 2020 budget, okay? And so in consideration of this profit and loss statement, here's some of the changes that we think are going to impact our 2020 budget. First of all, we've decided to expand our seat count by 25%. And since we expect to fill all of our seats, we're going to forecast 25% more revenue in 2020. Our lease is not going to change. We do expect our utilities to go up, and we're going to forecast a 25% increase in utilities just simply because we're going to serve 25% more customers in 2020. We've been notified by our accountant that in June of 2020, they're going to increase their fees by $25 a month. And then we've made the proactive decision that we're going to add $50 a month to our marketing efforts for 2020. And so given this profit and loss statement and given these anticipated changes, the question is, what will our 2020 budget look like? And so here's the process. There's our 2019 profit and loss statement. Not real easy to read, but that's okay. And to that profit and loss statement, we're going to apply these changes. And when we apply those changes, here's the 2020 budget that we come up with. And as you can see, the revenues month to month are indeed 25% greater than they are in 2019. The cost of goods sold goes up because of the increased sales, which changes our gross profit, actually increases our gross profit line for 2020. And then in the overhead section, we've incorporated changes where they occur. The lease stays the same. Utilities, we're budgeting 25% more of those. If we come over to June of 2020, here's where the accounting fee goes up by $25 a month. And then we've added $50 a month to marketing, which brings it up to a budget of $500 a month. And then, of course, the net income line is the net of all those changes that we expect to occur in 2020. Any questions on that process?
Nope.
Okay.
With you.
All righty. Okay, so now we've prepared the budget. And so how do we go about using that budget as a tool for managing our business? Well, in 2020, as we get into the new year, when we close our books for a given month and we have generated our profit and loss statement for that given month, we want to compare the actual results of that month from our profit and loss statement to the monthly budget we prepared. And the way that we go about doing that comparison is line by line in the profit and loss statement and in the budget, we subtract the actual value that we experience in the business from the budget value we prepared, and that gives us something called a variance. And our jobs as business owners is to try and understand what the variance is telling us. And so let's look at an actual result and an actual comparison between a profit and loss statement and a budget to see how this works. So here's the formula. Actual value minus a budget value equals a variance. And so here is our profit and loss statement from the month of May in 2020. In that month, these are the actual revenues we've generated. These are the actual costs of goods sold that we've incurred. And these are the actual overhead expenses that we've incurred. And this is the resultant net income for that month. And so what we want to do now is compare this to the May 2020 budget that we prepared the previous fall. And so here are those numbers. Revenues, cost of goods sold, overhead, gross profit, and net income. This is what we budgeted. This is what we actually experienced. And when we subtract the budget values from the actual values, here's the variance that we get. Now, the handy thing is if you're doing all of this in QuickBooks, QuickBooks will do this for you. It will generate this variance report. And so once you have that, our job as business owners is to look at those variances and try to figure out what they're telling us. And so when we look at these variances, here's some conclusions that we can come to. First of all, revenues are way down relative to the budget. What that means is last fall, we thought May was going to be a month where we generated 20,000 in revenues. And when we actually went through May, we only generated 16,000. And so that results in a negative variance of $4,000. Now, can anybody guess why a restaurant in May of 2020 would have had drastically lower sales than what was budgeted?
COVID.
Yeah. What?
COVID.
COVID, exactly. Exactly. This poor little restaurant may have probably had its dining room area totally shut down and was doing curbside delivery and Lord knows what else. And so, yeah, COVID hit. Well, back in last fall, when we were doing the budget, nobody in the world, literally nobody in the world knew anything about COVID. And so it resulted in a serious decline in revenues and this negative variance. So, okay, that's the way it is. As business owners, how are we going to fix that? Well, if your dining room is going to continue to be shut down, you want to really market curbside delivery heavily. You really maybe want to lay on Uber delivery, dash door delivery, other kinds of methods of fulfilling customers' orders and letting customers know that you're still open even though the dining room is closed. So with this knowledge of the effect of COVID, we can work on strategies to try and get around that. And as I'm sure probably everybody here knows, that's exactly what all the restaurants did as other businesses. Now, cost of goods sold, well, this is not a surprise since our sales were down. Obviously, our cost of goods sold right here should be down because we sold less stuff. We should have bought less food, less drinks, and had less labor. So that's not too much of a surprise. But here's the little hidden surprise that you always have to watch out for. Yes, Since sales were down, our costs were down relative to budget. But did the costs go down as much as they should have given the reduction in revenue? That's hard to spot unless you calculate the gross margin for your actual experience and compare it to your budget. So the gross margin for our actual profit and loss statement is 32%. That's the $5,000 here, gross profit, divided by our revenue of $16,000. Our budgeted gross margin is 36%. That's our budgeted gross profit of $7,000 divided by our budgeted revenue of $20,000. Well, obviously, the actual gross margin we experienced is less than our budgeted gross margin. And so what that means is there's an expense or expenses in there that did not go down as much as they should have. And just from experience, my bet would be this labor cost is the one that didn't go down as much as it should have. And so from a business owner's viewpoint, going forward, we want to really watch our labor costs and make sure it's commensurate with the amount of actual business that we're doing. And, you know, in the COVID atmosphere environment, what that meant was some people had to be furloughed for some period of time until business picked up. When we come down to overhead expenses, we can see that several of our overhead expenses were higher than budget. So, for example, utilities came in at over $600 where we had budgeted $563. Who knows? That one would be tough to figure out without more information. But look at our accounting fees. They were up to almost $600 when we had budgeted $325. Now, why would that be? Well, it's possible back in May when all of these disaster loan products were coming out from the federal government, we may have been talking to our accountant a lot about which ones to use, how to apply, all that kind of stuff. And guess what? The accountant was billing us for all those conversations. Okay. And likewise, marketing was up substantially from our budget of 500. Now, that could very well be a good thing. That could be our effort to of letting our customers know that we're still open, that we're still fulfilling orders, that we're still doing business and all of that kind of stuff. So in that case, an increase in a cost is actually a good thing. And so the bottom line here is, as business owners, the job is on us to figure out what the variances are, what they're telling us, and how we might fix the problems that we're encountering. Now, I know looking at this the first time, it probably seems like a bizarrely complicated thing to do. But really, we can express it as a 6-step process. First of all, we calculate the variances from our P&L and our budget. Then we focus on revenue, cost of goods sold, and gross profit numbers, because those are the most critical ones to understand, because these numbers comprise our revenue engine. It doesn't matter what our overhead is doing. If we're not selling and if we're not making gross profit, overhead becomes irrelevant. Oops. We want to understand what the variances are telling us. And we want to calculate the gross margin variances also, so we can understand exactly the relationship between revenue and those cost of goods sold numbers, and to find those hidden expenses that haven't gone down as much as they should have. Step 5, then we look at the overhead variances. Are there any surprises there? And if there are, is it something we can fix, or it's just something that we have to live with? And then finally, as business owners, we want to fix the problems to the extent that we can, but also to embrace the good news that comes our way. Most businesses right now in the third quarter are seeing business increases. That's good news. And so what we want to do is we want to do this month after month after month, because if we do this month after month after month, this 6-step process literally becomes second nature. Now, the first time you do this might take a couple of 3 hours to do this, depending on the complexity of your business and whether you can generate the variance report by QuickBooks or not. But as you do this over and over and over, and it becomes second nature, I would venture that most businesses, most small businesses, can whip this out in an hour or less, unless there's a really significant problem that you have to dig deep into. But the analysis part, it can be done in less than an hour. And it can be one of the most important and value-added hours you put into the business. Because the reason why you want to do this month after month is, first of all, it's going to give you a tremendous depth of knowledge about how your business works. And it forces you to focus on the important things: revenue generation and cost of goods sold. Second thing is, this process helps you to manage your businesses to meet your goals. You're now being proactive in management and not reactive. And so if you set out a goal for yourself or for your business, you can watch the numbers month by month and work on those numbers in order to actually reach those goals. And then the third great reason for doing this process is it's going to give you a competitive advantage. And the reason why it's going to give you a competitive advantage is because I can guarantee you that about 80 to 90% of your competition does not do this. Absolutely, they do not do this. And so if you apply yourself to this, this gives you an automatic competitive advantage. Okay, that covers the material for today. So let's just take a look at what we've gone through in this last hour or so. First of all, the profit and loss statement is the most important financial statement for monitoring the month-to-month performance of our businesses. It's absolutely critical that you have a well-formatted profit and loss statement. Gross margin, which is calculated from gross profit and revenue, is a value that you can use to help make management decisions, particularly if you're looking to create new positions or to buy new capital equipment for your business. The profit and loss statement is also the starting point for preparing a budget. And the budget is our forecast of what we think the next year of our business is going to look like financially. And then the next point is that our business performance month by month can be measured, quantified by comparing our profit and loss results to what we've previously budgeted. And again, this comparison is called a variance. And it's our job as business owners to understand what the variances mean and to make any corrections or decisions that allow us to maximize business performance. And so I want to thank all of you for being with us this morning. I hope that the information's been helpful. This is a link for going to our SBDC website and requesting business coaching, which will be at no cost to you. And if you have any questions at all about the content of this webinar, after you have chance to digest it or not, you can feel free to contact me at this email, and I'll be happy to try and answer your questions and encourage you to offer any if you do have any. So once again, thank you very much, and I hope you have a good rest of the day.